Okay, so welcome in. It is incredibly good to have you joining us today for another custom-tailored deep dive.
Mm.
We are examining a situation today that, well, it perfectly captures the structural vulnerabilities of our modern global economy.
It really does. It serves as this stark, real-time audit of just how interconnected our supply chains and financial markets actually are.
Right. We're looking at how a really complex geopolitical conflict happening on the exact opposite side of the globe can, within a matter of hours, just reach right into your daily life
Yeah.
and actively dictate the metrics of your personal wallet.
Yeah. And to guide us through the mechanics of this, we are relying on a highly detailed piece of source material today.
Exactly. It's a comprehensive report published on March 10, 2026,
Mm-hmm.
authored by economic and consumer affairs reporters Erica Alini, Andrew Galbraith, and Maria Postelyak. Their reporting meticulously details the immediate economic ripple effects following the U.S. and Israel strikes on Iran, and of course Iran's retaliatory strikes across the Middle East.
And what stands out in their analysis, I think, is the sheer velocity at which military action in one hemisphere translates into pricing volatility across North American consumer goods.
It's wild. So our mission today is to cut through all the noise and unpack the 6 key ways this specific conflict directly impacts the Canadian economy. We will be mapping out the chain reactions affecting international travel, the price of crude at the pump, the surprising resilience of the TSX, the valuation of the Canadian dollar upstream agricultural costs, and finally, the bond market's influence on your mortgage.
That is a lot of ground to cover.
It is, but the goal is to provide a clear mechanical understanding of these economic factors without bogging you down in information overload.
But before I move into the analysis of those 6 areas, we do need to establish a really firm parameter for this deep dive.
Yes, absolutely.
Given the highly sensitive and deeply complex nature of the geopolitical events described in our source material, we will strictly and exclusively analyze the economic and financial impacts exactly as they have been reported in the text.
Right, so we're not taking any political sides here.
Precisely. Nor are we endorsing any viewpoints regarding the United States, Israel, or Iran. Our discussion remains entirely neutral. We are focused solely on conveying the factual economic consequences and consumer impacts that the reporters outlined.
Okay, let's unpack this. The first wave of economic impact hits our logistics networks, specifically shuttered airspace and the ensuing travel disruptions. The reporting notes major transit hubs, we're talking Dubai, Abu Dhabi, Doha, are severely impacted.
And looking at the mechanics of global aviation, these aren't merely destination airports. They operate as critical central arteries for international transit.
They're massive hubs.
Exactly. When you disrupt the airspace over the Arabian Peninsula, you effectively sever some of the most efficient flight paths connecting Asia, Europe, Africa, and North America.
The ripple effect is just immediate.
Right. We aren't just talking about a few delayed passenger routes. We are looking at massive disruptions to global routing efficiency.
And the timeline provided in the text really highlights just how abrupt this logistical bottleneck is. By Monday evening local time, the UAE had only managed to resume a highly limited number of flights, and they were explicitly prioritizing stranded passengers,
While Qatar's airspace was entirely closed.
which forces a massive operational pivot for domestic carriers. Air Canada enacted flexible rebooking policies, but the blunt reality hit Monday when they took to X to announce outright cancellations. Flights from Canada to Israel and Dubai were cut until March 22, targeting a March 23 resumption.
Navigating that kind of operational chaos requires a close reading of federal travel advisories, because the government's risk assessment directly dictates the financial protections you actually have available as a traveler.
Oh, that's a really good point.
Yeah, Ottawa issued level 4 advisories, which means do not travel for Iran, Israel, the UAE, Qatar, Kuwait, and Bahrain.
And alongside those, they issued level 3 advisories for destinations, including Saudi Arabia and Oman, which means avoid non-essential travel.
Right. And the distinction between those levels is critical for anyone holding a ticket right now. The source material outlines a highly practical mechanic regarding trip cancellation or interruption insurance.
Basically, a level 3 advisory is typically the exact threshold that triggers a policyholder's eligibility to file a claim.
And that is a vital piece of financial leverage for you. The insurance underwriters rely on those specific federal classifications to assess viable risk.
So once the government officially classifies a region as level 3, the parameters of most standard travel insurance contracts are officially activated.
Exactly, allowing consumers to recoup their capital rather than absorbing the cost of a global disruption.
Okay, so let's pivot from aviation logistics to the most immediate and visible economic indicator of global tension: the energy markets.
Always the first thing to react.
Always. The reporting details a significant surge in oil prices immediately following the strikes. Brent crude, which is the global benchmark, jumped as much as 13% in the futures market. It hit $82.37 US a barrel at its peak before settling up 6.7% at $77.74.
Which is a huge swing.
Yeah, and the downstream translation of that is an expected 3 to 6 cent per liter jump at the pump for Canadians, and that could hit as early as Wednesday.
Now, a 6-cent jump is definitely painful for consumers, but what's fascinating here is the underlying market architecture that actually prevented a much more severe price shock.
Wait, prevented?
Yeah, the reporters detail a set of specific logistical and policy buffers that actively suppress the baseline price of gasoline prior to this event.
Oh, right. The text attributes that depressed baseline to a couple of distinct factors. First, we have Ottawa mixing the consumer carbon levy, which inherently lowered the floor price.
And second, there was a notable drop in oil prices in early April, driven by market uncertainty surrounding U.S. President Donald Trump's potential tariffs.
So those factors essentially created a localized pricing anomaly.
Exactly. Because the baseline cost had been trending downward since last spring, the sudden geopolitical spike is essentially filling in a deficit, rather than compounding on top of an already inflated price.
That makes a lot of sense. But beyond just localized policy, the reporting highlights a massive structural buffer in the global supply chain, the utilization of floating storage.
This is one of the most interesting parts of the report.
The logistics of that floating storage concept are wild. It's essentially parking massive oil reserves out at sea, fully loaded on tankers, just waiting for a market shock.
It functions as a real-time shock absorber for the futures market. Brooke Thackeray, a research analyst at Global X, details how this floating inventory mitigates immediate supply crunches.
Because rather than relying solely on land-based pipelines or stationary storage facilities that might be geographically vulnerable,
these tankers are already positioned on the water, right? When a geopolitical event threatens to bottleneck regional production, that floating supply provides a vital buffer of accessible inventory. It effectively caps the initial panic pricing we might otherwise see on the trading floor.
that is fascinating. Now, speaking of panic pricing, let's talk about the stock market. Because with all this global tension, you'd expect the markets to completely tank, right?
That is the standard historical expectation, yes. A massive market sell-off.
Yet the report highlights that both the S&P TSX Composite Index and the S&P 500 bounced back from early losses, and the TSX actually closed at a record high.
A record high during a geopolitical crisis.
It feels entirely backward. How does a regional conflict equate to a TSX boom?
It seems counterintuitive until you analyze the specific composition of the Canadian equities market. The TSX is heavily weighted toward the energy and resource sectors.
So the same surge in global crude prices that drives up costs at the gas pump?
Simultaneously inflates the valuation of Canadian energy producers. That sector-specific rally acts as a massive buoy for the broader index.
The source actually includes a direct analysis from Thackeray on this exact dynamic. He notes that as long as the conflict persists without a clear resolution, the Canadian energy sector is positioned to be the primary beneficiary in the equities market.
Which creates a really complex scenario for domestic investors. Your cost of living increases at the pump, but your investment portfolio potentially outpaces those costs.
It's a weird silver lining. But the reporting strategically balances that outlook with a warning from Philip Pedersen. He's the chief investment strategist at IG Wealth Management.
And his advice is highly pragmatic given the volatility.
Yeah, he specifically warns against attempting to day trade a geopolitical conflict based on these early movements. His direct guidance is to embrace your diversified portfolio and simply ride it out.
It's a necessary caution against reactionary capital allocation. You cannot reliably model the day-to-day escalation of military events into a short-term trading strategy. It's just too unpredictable.
So tracing the impact of those energy markets to our currency reveals another really interesting dynamic. Usually, the historical correlation dictates that when crude spikes, the petrocurrency follows suit. High oil means a high loonie.
That is the traditional textbook relationship.
But despite the jump in oil, we saw a distinctly subdued loonie. It was hovering right around 73 cents US. So what does this all mean for the Canadian dollar?
The reporting defines this as a delicate balancing act, a currency tug of war, if you will. The upward pressure from the energy markets is actively wrestling with the broader macroeconomic flight to safety.
Right, because in moments of severe global panic, Institutional capital flees riskier assets.
And seeks shelter in safe haven currencies, overwhelmingly the US dollar.
So while Canada's energy export profile provides a natural upward force for the loonie, the massive global influx of investors panic buying the greenback essentially neutralizes that momentum.
The two macroeconomic forces cancel each other out against the US dollar. You end up with a relatively flat valuation.
But the comparative strength of the Canadian dollar is where the real structural advantage lies. The text notes that against currencies heavily exposed to energy imports, specifically the euro and the yen, the loonie, actually appreciated.
Because those economies lack the domestic energy production required to insulate themselves. When global oil spikes, their import costs skyrocket. That degrades their trade balances and weakens their respective currencies.
So Canada's status as a net energy exporter acts as an economic shield.
Exactly, protecting the domestic currency from the severe devaluation experienced by pure energy importing nations during supply shocks.
Okay, here's where it gets really interesting. Moving from the macro markets into downstream consumer impacts. The report outlines a slow-moving systemic threat to the cost of groceries.
This is where it hits home for everyone.
We are looking at how a maritime choke point halfway across the world fundamentally alters the input costs for Canadian agricultural producers.
This represents the transition from immediate market shocks to embedded supply chain inflation. The geographic focal point here is the Strait of Hormuz. That's the critical maritime thoroughfare situated between Iran and Oman.
And the volume of global commerce relying on that specific waterway is staggering. The reporters drop some heavy stats here. 45% of global sulfur exports and 35% of urea shipments pass directly through that strait.
And those two commodities, sulfur and urea, are the foundational inputs for agricultural fertilizer. If maritime traffic through the Strait of Hormuz is restricted or threatened, the shipping costs for those materials absolutely surge.
Which initiates a brutal domino effect for the consumer. Restricted strait equals elevated shipping costs, which equals pricier fertilizer.
And higher input costs for farmers mean it is significantly more expensive to yield crops. Those costs don't just evaporate.
No, they are passed directly down the supply chain, resulting in renewed upward pressure on food prices at your local supermarket.
Which is particularly concerning given the current economic climate in Canada. The text explicitly points out that food prices have remained a highly persistent sore point for consumers, even as other inflationary metrics have shown signs of cooling.
So any localized supply chain bottleneck regarding urea shipments threatens to completely reverse that progress.
It does. Now, the text does acknowledge a minor offset here, again tying back to our status as an energy exporter.
Right, because the loonie appreciates against certain global currencies during these energy shocks, it can marginally lower the cost of imported goods.
But the vulnerability of agricultural inputs seems to drastically outweigh that minor currency advantage.
And the sticky inflation, whether it's driven by elevated crude or rising agricultural costs, bleeds directly into the bond market. Which brings us to the final and perhaps most critical economic vector we need to cover: interest rates and mortgages.
This is where global geopolitics directly intersects with domestic housing costs. And this is your biggest potential expense. The text explains that persistent global inflation worries are prompting investors to push up bond yields.
Let's really trace that mechanism, because understanding how investor anxiety dictates local lending rates is crucial. How exactly does the bond market alter the cost of a mortgage?
Well, the bond market operates on future expectations. When institutional investors see a sustained threat of inflation-like pricier fertilizer and higher gas, they demand higher yields on government bonds to compensate for the diminishing future purchasing power of their returns.
And those rising bond yields directly establish the cost of capital for Canadian financial institutions.
Exactly. When a bank's internal borrowing costs increase in the bond market, they immediately pass those increased costs on to the consumer by raising the rates on fixed mortgages.
So anyone looking at a fixed rate is entirely at the mercy of those bond yields.
Yeah.
But the variable rate market gets squeezed from a completely different angle. Variable mortgages are tied to the Bank of Canada's trend-setting policy rate.
Correct. The market expectation had been that the central bank would lower its policy rate this year.
But geopolitical supply shocks that drive up domestic consumer prices force the central bank to maintain a restrictive monetary stance.
They simply cannot confidently pare back rates if they're actively fighting imported inflation from global energy and agricultural markets.
Which creates a highly stressful environment for borrowers. But the reporting highlights a highly actionable defensive strategy from Ron Butler. He's the founder of Toronto-based Butler Mortgage.
Yes, he took to X to explicitly caution mortgage shoppers against making panicked financial decisions based on short-term bond market gyrations.
His guidance centers on a specific mechanical tool available to consumers, the rate hold.
The 120-day pre-approval rate hold. It essentially functions as a zero-risk financial hedge against global
I
instability.
love how they break this down. By securing a pre-approval lenders guarantee a specific mortgage rate for that set period of up to 120 days.
So if the geopolitical conflict escalates, driving inflation higher and pushing bond yields up, the borrower is fully insulated for those 120 days. Their rate is completely locked.
And the absolute beauty of the strategy is the lack of downside risk. If the conflict de-escalates, the supply chain normalizes, and rates fail to rise, the borrower simply lets the rate hold expire.
It costs absolutely nothing to initiate, but provides absolute protection against sudden capital market shifts.
It's a perfect example of leveraging the mechanics of the financial system to shield yourself from macro volatility.
It is a vital tool for risk management in a really unpredictable economic environment.
Okay, let's pull all these threads together. We started with a localized military conflict and traced a highly complex web of economic reactions directly impacting you, the Canadian consumer.
We examined the massive logistical disruptions at key global transit hubs, forcing sudden operational pivots for airlines.
We mapped the immediate spike in global crude, noting how localized policy and an armada of tankers holding floating storage prevented a more severe shock at the gas pump.
We analyzed the structural composition of the TSX, exploring how the energy sector buoyed the broader market, while the Canadian dollar fought a macroeconomic tug-of-war against the U.S. greenback, ultimately flexing its strength against energy-reliant currencies.
And finally, we tracked the long-tail systemic threats. How a potential maritime bottleneck in the Strait of Hormuz threatens agricultural input costs and downstream grocery inflation, and how those broad inflation fears squeeze the bond market, directly impacting the cost of local mortgages.
It is a massive web of cause and effect.
Making sense of these dense, highly technical economic vectors without the panic is exactly why we do this. Thank you so much for joining us and trusting us to unpack this vital reporting with you.
And I want to leave you with one final thought to ponder. If a military conflict on the other side of the planet can so swiftly rewrite the cost of an everyday item like plant fertilizer, and subsequently the food on a Canadian dinner table, perhaps the true cost of our interconnected global economy isn't measured just in dollars.
What do you mean by that?
I mean, it's measured in an absolute fragile dependency on global peace. I invite you to look around your own home today and consider what other everyday necessities are quietly tethered to a maritime choke point thousands of miles away.
That is something to think about. Until next time, keep digging, keep questioning, and thanks for taking the deep dive.